This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Today's discussion delves into the intricacies of the Federal Open Market Committee, a pivotal body within the Federal Reserve System. It's a complex topic, but crucial to understanding monetary policy in the U.S.
Indeed. The FOMC's actions directly impact interest rates, credit availability, and ultimately the entire U.S. economy. It's a fascinating mechanism with far-reaching consequences.
Exactly. Many people hear about the Fed raising or lowering rates, but few understand the process behind those decisions. Let's start with the committee's composition. How is it structured?
The FOMC is composed of the 7 governors of the Federal Reserve Board and 5 Reserve Bank presidents. The New York Fed president always has a seat, while the other 4 rotating presidents are elected annually by their respective regional bank boards.
So it's a blend of national and regional perspectives that seems designed to balance different economic viewpoints. You mentioned the election process. Can you elaborate on how the Reserve Bank presidents are selected?
It's a multi-step process. Each of the 12 Federal Reserve banks has a board of directors. These boards then elect their representatives to the FOMC, with each board having 1 vote. The process ensures representation from various geographic regions and economic sectors.
And what about the alternates? What role do they play?
Each elected president also has an alternate, typically a first vice president, who steps in if the president is unavailable. This ensures continuity and prevents disruptions to FOMC meetings.
So a robust system designed for both representation and stability. Let's move on to the committee's responsibilities. What are its primary functions? The FOMC's primary responsibility is conducting the nation's monetary policy, but what exactly does that entail?
It involves managing the money supply and credit conditions to promote maximum employment, stable prices, and moderate long-term interest rates. This is achieved primarily through open market operations.
Open market operations. Can you explain what those are in simple terms?
Essentially, the FOMC buys and sells U.S. Treasury securities and other financial instruments in the open market. Buying securities injects money into the economy, lowering interest rates, while selling securities withdraws money, raising rates.
So it's a delicate balancing act, influencing the flow of money to achieve specific economic goals. What factors does the committee consider when making these decisions? The FOMC's decisions are based on a complex interplay of economic indicators. What are some of the key factors they consider?
They analyze a wide range of data, including inflation rates, unemployment figures, GDP growth, consumer spending, and business investment. They also consider global economic conditions and potential risks to the financial system.
And how often does the committee meet to make these crucial decisions?
The FOMC meets at least 8 times a year, typically in Washington, D.C. These meetings involve extensive discussions and analysis before reaching a consensus on policy adjustments.
So it's not a quick decision-making process. It requires thorough deliberation and consideration of various perspectives. Let's talk about the impact of their decisions. The FOMC's decisions have a ripple effect throughout the economy. How do these actions influence different sectors?
Changes in interest rates affect borrowing costs for businesses and consumers. Lower rates stimulate borrowing and investment, boosting economic activity, while higher rates curb inflation but can slow down growth.
And what about the role of the Federal Reserve banks in this process?
The Federal Reserve banks execute the FOMC's directives, conducting the actual buying and selling of securities in the open market. They also play a crucial role in monitoring economic conditions within their respective districts.
So it's a collaborative effort between the National Board and the regional banks. Let's discuss the transparency of the FOMC's operations. To what extent are the FOMC's deliberations and decisions transparent to the public?
The FOMC strives for transparency, releasing statements after each meeting summarizing its decisions and rationale. Minutes of the meetings are also published with a slight delay to allow for thorough review.
And what about accountability? How is the FOMC held responsible for its actions?
The FOMC is accountable to Congress, which oversees the Federal Reserve System. The chair of the Board of Governors regularly testifies before Congress, explaining the committee's actions and responding to questions.
So a system of checks and balances ensures that the FOMC operates responsibly and is held accountable for its impact on the economy. Let's discuss the historical context of the FOMC. The FOMC has evolved over time. Can you shed light on its historical development and significant changes?
The FOMC was established in 1935, significantly altering the structure of monetary policy. Its evolution reflects changes in the understanding of monetary policy and the challenges faced by the U.S. economy.
And what are some of the key challenges the FOMC has faced throughout its history?
The FOMC has navigated numerous economic crises, including the Great Depression, stagflation in the 1970s, and the 2008 financial crisis. Each crisis has presented unique challenges and required innovative policy responses.
So the FOMC's history is a testament to its adaptability and its crucial role in stabilizing the U.S. economy during times of uncertainty. Let's discuss the future challenges facing the FOMC. What are some of the key challenges the FOMC is likely to face in the coming years?
The FOMC will continue to grapple with balancing economic growth and inflation control. Technological advancements and globalization also present new challenges to monetary policy.
And how might the FOMC adapt to these evolving challenges?
The FOMC will need to remain flexible and adapt its strategies as needed. This includes continuous monitoring of economic indicators, refining its models, and exploring new policy tools.
So continuous learning and adaptation are essential for the FOMC to effectively navigate the complexities of the modern economy. Let's discuss the importance of the FOMC's role in the global economy. The FOMC's decisions have global implications. How do its actions affect other countries and the international financial system?
The U.S. dollar's role as a global reserve currency means that FOMC actions influence interest rates and exchange rates worldwide. This can have significant impacts on global trade and investment flows.
So the FOMC's role extends beyond the U.S. borders, impacting the global economic landscape. Let's discuss the criticisms leveled against the FOMC. The FOMC's actions are not without criticism. What are some of the common criticisms leveled against the committee?
Critics argue that the FOMC's policies can be unpredictable and have unintended consequences. Concerns about transparency and accountability are also frequently raised.
How does the FOMC respond to these criticisms?
The FOMC strives to improve its communication and transparency. It also engages in ongoing research and analysis to refine its models and improve its policymaking.
So the FOMC acknowledges these criticisms and actively works to address them. Let's discuss the overall significance of the FOMC. In conclusion, what is the overall significance of the FOMC in the context of the U.S. and global economies?
The FOMC plays a vital role in maintaining the stability and health of the U.S. economy. Its actions have far-reaching consequences, both domestically and internationally. Its effectiveness is crucial for economic growth and global financial stability.
That is a great discussion. Thank you for sharing your expertise.